show, but first, the spotlight on the currency. That's fallen close to 10% in the last 2 months, 9% since the 31st of March. What's the road ahead? Harihar, Head of Treasury at First Rand Bank, DK Joshi, Chief Economist at Crisil, join us on this conversation. Gentlemen, many thanks for joining. Mr. Joshi, specifically on this issue of current account deficit, I was reading your report where you allude to the fact that it could go down to about, current account deficit to GDP could go down to about 4.5% for 2013-14. The Reserve Bank of India has made it very clear that it's hoping that it will settle around 2.5% or 2.4 to 2.8%. What is the realistic number as far as the CAD is concerned? Do you think, given the factors that Hari has mentioned of easing commodity prices and so on, we are likely to see the CAD improving from here on, or do you think there will be more pain?
Well, I think for the year as a whole, for 2013-14, our forecast is 4.5% of GDP. That's, I think if you look at 2012-13, my sense is that it's going to settle at around 5%. So there is a decline, and I think the reasons, as were explained, I think one of them is that there will be a slowdown in gold imports. And I think that's going to play out. And then commodity and crude prices, I think they are soft and are likely to remain soft because you're not getting any strong news from China either. So I think the upside there is limited. So I think that will help to bring the current account deficit down. But it's going to be way above what the central bank targets at around 2.4, 2.5% of GDP, which they regard as the prudent limit. So I think the vulnerability of the economy is still very high, and I think even smaller shocks are causing bigger ripples, I mean, as far as the currency is concerned.
Mr. Joshi, specifically on this point of FII is unwinding, Rangarajan again alludes to the fact that some of the comments made by the Federal Reserve may have been misinterpreted. My question to you is that we have seen FIIs unwind their position in debt to the tune of about $5 billion. Are you expecting more unwinding to happen? Do you think in the near term we are going to see outflows?
Well, I think that could happen, but I think that the big shock is over. I mean, in the sense that there's no other tail risk, at least right now, which seems to be there in the horizon. So I don't see a big sell-off unless there is some news from the U.S. Fed. But I think they have also laid out the plan quite clearly. I mean, this time I think central banks are generally nuanced. I think they have set out a very, very clear plan. So I think that should give some comfort to or certainty to the market. There was, I think, a knee-jerk reaction because QE is an untested policy. So you don't know how it's going to behave when it is unwound. So I think there is a lot of uncertainty surrounding that. And I think one should not forget that this is only unwinding of QE. I think we are not talking of interest rate increases as of now, which I think the Fed says will happen sometime in 2015. But even the unwinding of QE is going to lift the bond yields. So I think it will, the bond markets will not be that attractive. So there will be pullback, I mean, from bond markets. It could continue. Very hard for me to say what the scenario will be going ahead. But my belief is that the big shock is, I think we've passed through that stage.
That's an interesting point. You're actually saying that the big shock is over. We moved through the phase of pain. Mr. Joshi, in the past few days, we've seen markets like Indonesia, Brazil move on hiking interest rates. My question to you is the direction of the rupee really defining monetary policy at this point in time? How do you expect the Reserve Bank of India to read what's going on?
I don't think the monetary policy will be dictated by the currency completely. I think I don't see a situation where RBI will start raising rates. Yeah, it is one of the factors that enters into their equation, and I think right now it is signaling that they should pause. I mean, and that's exactly what they did in the mid-quarter policy, and we also expect them to pause for some more time unless there is more clarity on where the currency is headed. And currency is if the rupee sustains at these levels, then obviously it has an inflationary impact, and our forecast for inflation is around 5.3%, and then if rupee remains at close to 59.60, then I think you get an inflation of around 6%. So it does, I think, and it does irritate it actually pushes the inflation above what RBI is targeting. So
Sure.
I think they would be cautious because of that. I think apart from that, I think just from the yield perspective, I don't think central bank will be the dominant factor for central bank action.
Sure. But sir, the yield on the 10-year paper at this point in time, if you compare it to similar maturity period US Treasuries, there is still about a 4% gap. How do you expect the 10-year paper, the yields to behave in the medium term?
Well, I think our forecast for 10-year bond, Indian 10-year bond is 7.3 to 7.5 by March 2014. And I think that's premised on one more round of easing by the central bank, and also on the fact that inflation is going to remain quite moderate. So I think the bond yields had actually come off quite a bit, and they have again risen in India. And my sense is that they're going to decline further. And as far as the fiscal is concerned, the government has actually controlled the fiscal deficit to a greater extent than was expected. And I think this is likely to continue this year also. So I think overall there will be some softening of bond yields, but not beyond. I don't think they'll settle below 7.3%.
All right, gentlemen, we leave it there. Harihar, DK Joshi, many thanks for joining us with your perspective on Bloomberg.